everybody. Welcome.
What's up, everybody? All right, so we're good. The people are saying that the audio is good. All right.
Yes, y'all know this is the first time ever that my audio has been my audio has been good from the jump. Hello, we already got 225 people in here in the chat. Do you see them, Mark?
Yes, I do.
Yes. Hey, everybody. Y'all tell us where you're coming in from.
Yes.
Hello,
I wonder how many folks from Seattle will show up. This should be interesting.
Ooh, we should play a game. Let's see how many from Texas versus Seattle. Or how about this?
I don't know. I think
South
Texas
side.
I was going to say. You got to have to bring it down a little bit because Texas versus Washington.
How about, okay, South side versus West Coast.
Okay.
Y'all tell us where you're coming from. We'll see who has the most.
Okay. But what do we do about folks from the East Coast? Oh, I also saw that there's somebody in from Tokyo, Japan.
Oh, well, they won. They already won. Like, right? Drop the mic or the pen, whatever it is.
You win.
Oh, and they're coming so fast. I see you guys from all over. 480 people in the webinar. Everybody on Instagram. Hey, guys. Hey. If you are wanting to make sure that you get the replay or that you are with us a little longer, make sure you go to the link in either one of our bios. I'm Teri and I'm an investor, and this is Mark at I am Mark Monroe. So make sure you check the link in our bio and register because we're also on webinar. That way, when Instagram throws the deuces, you'll still be with us.
Yes.
I see some New Jersey, some people in the South Side, Atlanta.
I think the South has got it. I think they
go South Side.
Come on, West Coast, don't fail.
West Coast, don't fail him. Any West Coast people? I'm seeing Raleigh. I'm counting every state.
I'm seeing Maryland. South. I'm seeing Houston. Be more in the building.
Texas. All right.
Oh, what? I got one West Side. There we go. Oh, we got Memphis. See, there we go. New Orleans. I mean,
still
Texas
South.
Again.
Still South. South Side. So this is what I'm hearing right now. I'm hearing that when all these people from the South learn how to invest, we're gonna like change the world. The dynamics in the South Side are gonna be amazing. You're gonna see all these people flourishing with all this wealth on the South Side, and we're gonna leave West Coast in the dust.
It's okay. As long as some of these property values on the West Coast can drop a little bit, then that would be perfect. So these property taxes over here are a killer.
See, I actually have a friend visiting now. He's lives in Oakland, but his job just said that they could work from home. So he's like, I need to go somewhere with no property tax. So check out Texas, check out
check out Washington State.
Do you also invest in real estate too, Mark, or just stocks?
More so, I like the market and startups. Those are my focus.
Okay.
I like those. I mean, real estate, a lot of my friends are trying to get me in there. I'm thinking about shipping container homes as a potential investment, but right now it's all about startups.
Yes. And shout out to Mobile Home Elite. They're like killing it. Those my friends for real. The wife of the mobile home team, she's in my class. She's one of my students, my trade and travel students.
Dope. That's dope.
Yes. Love it. All right, guys. And then I told Mark what questions we were going to get from the jump. I said, somebody's going to ask about the replay. So yes, if you're here in the webinar, there is a replay that's going to be sent. And for all those on IG, hey, everybody, I see 200 of you guys in IG. If you all come on to the webinar, check the links in our bio, then you can get the replay. So make sure that you register. And then what else? Oh, if you can't see, technical difficulties, if you can't hear or see, make sure on the webinar that you just press refresh and then it'll work. Y'all know webinar.
And if I drop out of IG Live, I promise I will be right back.
Yes. We got to cover all the bases. And mine keeps like dimming. So I'm like, come on now. Like, do I need to touch this thing?
Yeah.
Is yours dimming too?
Yeah, mine does the same thing.
Oh, come on now, IG. I need y'all to work with us. But how about let's get started? So we're 5 minutes in. Everybody, please press like and press share on the IG. Press like and press share on the webinar. Invite a friend. Tell them we out here. So let's introduce ourselves. So you want to go first, Mark?
Sure. I'm Mark Monroe, just a man. Pretty much live in Seattle, Washington, or Auburn, Washington, if we want to be specific. I am a venture capitalist investor where I get to invest in early stage startups. And then on top of that, I love to be a options trader / investor. So that's pretty much my forte. I am married to one of the most amazing women that I've ever met in my life. And that's my wife, Erica Monroe. And I have a wonderful dog by the name of Butter, which is like my son, and until the first child comes.
Is that coming soon? Should we be on the lookout? And he sips his water. That's the answer to the question. All right, fine. Too many questions here. I get it. No, I'm just playing.
I mean, soon come, and very, very soon come. So
okay. Erica's like, Teri, don't ask him that on live.
No, now it's like, hey, remember what you told Teri? Yay.
Yes. And I am Teri Ijeoma. So hey, everybody. I am a stock and options trader. I've been trading for about 10 years, but for most of that time, it was a side hustle. I worked in education and nonprofits, and my last job was an assistant principal of an elementary school. And I know, right? And I like the moment that sticks in my head is there was this one bad kid. And actually, he was one of my favorites because the bad ones are always your favorite.
Always the favorites.
Right? But he came in my office and literally he knocked over everything. He knocked over the tables, took all of the paper and threw it all around my office. And then when his mom got there, she had the nerve to yell at me like I was the problem. I was like, oh, no, baby. Nope.
Ain't going down like that.
Right? Do you see this? And then I'm like, and the reason why your child is here is because he threw a stapler at another kid. You need to be apologizing to the other kid's parents.
Oh, man.
So yeah, needless to say, I needed an exit strategy. And so I decided that I was going to start trading stocks full time. Like it wasn't just going to be a side hustle. It'd be a full-time thing.
Nice.
So I started working my way up to $300 a day because that's all I needed to replace my income. I didn't need a lot. And I was able to do that, quit my job and start traveling around the world. And so, yeah, so that's why now I teach people how to trade and travel. How do you
Super dope.
Use stocks to start building up your, like paying off debt, build your dreams, save for a house. Like you can use stocks to do that or to replace your income. And of course, like now I've gotten to higher and higher levels. So now like I got to the $1,000 in a day, then the $100,000 in a day, right? Right. So that's what I do. And I'm sure shout out to all my trade and travel students that are on here. Just really love helping everybody.
Nice.
Yes. So tell us, and you were modest. So he's got like a come up series. Like one of the reasons why Mark and I even got connected is he was on Earn Your Leisure and he was like, yeah, I had this trade and it had gone wrong, but it was like $18 million.
Yes.
And I was like, okay, now, clearly I have some things to learn. I'm in the millions now, but I'm not at that level. So there's so much to learn at every level. So I'm so excited, Mark, that you even decided to talk with me today. This is going to be really fun.
Thank you for having me. I do it so that way, I always want people to learn from my mistakes. So that way it's not their mistakes and that they can do better than what I always did. So I'm here for the culture. So let's do it.
Yay. Of course.
Uh-oh.
And yeah, refresh your Insta because your volume on Insta went out. Oh, it's rebuffing. Okay, but that's okay. That's why we got the webinar jam. So I guess the first thing we wanted to talk about was introducing everybody.
There you go.
Oh, it's back.
There you go.
We told y'all from the jump. If this starts acting
it.
funny, make sure that you click our link in the bio so that you can see the actual webinar. This is recorded. There'll be an email sent out after with the link to the replay. So make sure you do the link to the webinar.
Instagram is like, you guys are using way too much bandwidth.
Right? They're like, oh, you got 300 people, and they don't even see the 740 people that are in the webinar. And thank y'all so much for coming. This is such a blessing. So let's first talk about what an option is for all those that are like first starting out. So how would you describe options?
So pretty much option is pretty much you have the option to buy or sell a stock, but you're pretty much trading off of a contract. So in every contract, there's 100 shares. And so I always do it very simple in the sense of imagine an option, like a lease option to own for a house. Yeah. So anybody who wants to buy a house. So say, for example, you want to buy a house, but you don't have like, that 20% down payment type money to buy your house, then pretty much you will talk to the landlord or the owner, and they will give you a 2-year option to buy this house. So then they set an agreement with you and say that the house is $400,000, right? And then at the end of the 2 years, let's say that the house appreciates to, let's say, $600,000. But you're on the contract for $400,000. So you just had a major come up of $200,000, and pretty much you have the option to either exercise and buy that house at that $400,000 with the profit locked in, or you have the option to pass on it.
Yeah,
I mean, that pretty much explains what options is.
It is. So like I kind of say something similar. So it's a contract. Okay. The same way that, so I also was in real estate for a long time. If we were buying a house, then we'd have to sign a contract, and we would say how much we want to purchase the house for. So that would be our purchase price. And then we'd have a date that we were doing our closing. So some day in the future would be the day that we'd close on the contract.
100%.
And so when we do that, that's very similar to a contract in options. In options, you're basically saying, I'm going to buy 100 shares of a stock. And then you say what your price is, and that price is going to be your strike price. Just like in the house, you have what price you're willing to purchase the house for. You have what price you're willing to purchase those 100 shares for. And then you also have a closing date. What day in the future are you guys going to execute this contract? For us in options, that's our expiration date, the day that this contract expires. So it's very much you are buying and selling contracts. And then what's also kind of cool about it is I think of it like, in wholesaling and with houses, you can buy you can negotiate an agreement. Yeah, that I'm going to have this house, and we're going to do it for this price and this date. But then you go sell that contract to an investor for a higher price.
Take the profit.
That's what we're doing in options. We've got this agreement, and if the contract goes up in value, we go sell it to somebody else and take the profit. So yes,
100%.
So that's what So does that make sense to you guys? Y'all put what we want to put put coins in the chat if that makes sense. Did that kind of make sense? You guys understand a little bit more about options from that? Dre says, great analogy. Fran Chan says, love this. Love this. I want to see, y'all know I'm from education. I'm waiting for some coins in the chat.
There it is. Now all of a sudden, as soon as you said that, it just flooded the chat.
There we go. Thank you for appeasing the teacher.
Don't make me ask again.
Right? No, the real teacher comment is, I'll wait. And then you just wait. You wait for people to respond or wait for the kids in the class to start acting right.
It's like those early morning. It's like everybody's still waking up. So and it's like when you go to class, the teacher is like super lit, and everybody's just like, look, I just woke up.
They're like, my mama made me come. I don't even want to be here. That's literally like what they say. But I appreciate it. I see a ton of coins in the chat on the webinar, and I'm seeing money bags and coins on the IG. So you guys are killing it. So good. So now you have a concept of what options are. So now I wanted to talk to Mark a little bit about now there's a risk involved with options versus stock. So now we got to talk a little bit about like, well, why would someone trade options instead of just doing stock? What you think?
So I think the reason why a person will want to trade options versus, say, for example, stock is because, of course, the money is just different. So the returns that you get from an option trade versus the returns that you get from stock. So let's say 1% bump in any stock is great. But say, for example, 1% bump in an options trade, we like to say it's just different. I like that. But then at the same token, though, when we talk about risk in perspective, there's not very much risk in owning a stock unless, you know, the company's doing some nefarious activities that we've been hearing about over the 2020 and 2019.
Right.
But
which is all the time. Yep.
Right.
Yep.
But for the most part, it's like, you know, you're pretty much holding on to ownership of a company that you expect growth over periods of time, over the long term. Now, when you think about option contracts, what you invest is what you can lose. So one of the things that I always ask people is, how much are you willing to invest in something? And then the very next question that I ask is, how much are you willing to lose? If those two numbers don't align, then honestly, you're not ready to perform such an option trade at all, because you can go from, let's take a hypothetical of investing $1,000 into an option contract or into an option trade. And if that option trade goes south, you lose $1,000.
Yep. And I'm sure, has that happened to you? It's definitely happened to me. Like the value of your option just goes away.
You didn't hear about what I lost. We keep hashing that one. It's like throwing salt in.
Oh no! What had happened was I wasn't trying to throw salt. I was trying to show how you've learned and grown so much since then.
Okay. I'm a brother man's fine these days.
True. I heard also about like your Tesla wins and the good things on the other side too. So this is good. You're like, see, that's why I can afford my baby. My new baby is soon to come, maybe.
Yes.
But yes, like, so for all of my IWT students and just everybody here, like, Mark is so right. So the rewards are so much higher in options because, like we said, every contract is like trading 100 shares of something. So when you're thinking about like 10xing and like 100xing, like your gains, then you're literally trading 100 shares at a time versus just one share. And as he said too, like you also don't have to put as much like down to control those 100 shares. Because controlling a contract costs a lot less than controlling, like actually purchasing the stocks outright. So like that's where your reward comes. But then on the flip side, well, what happens if you get to that expiration date and that contract isn't valid anymore? It'd be the same thing as you bought a house for $600,000. Like, let's say you're in Texas and you bought this beautiful home for $600,000 because you thought that a big development was going to come. So like this mall was supposed to come down the street. And so everybody's house is just, you know, the price. Right. But it happens. Right. But so they've sold you on this big thing because this big development is going to come. So all the houses are $600,000. And then maybe a year goes by and all of a sudden they decide, oh, never mind. We moved the location of the development. It's not coming. And all the houses are now worth only $400,000. That's a lot. Or what if there's a tornado that comes through and they're worth nothing? So that's kind of the risk you also take on with these options contracts. 100%. By the time it expires, it may also be worth nothing. And so if that's the case, as Mark said, however much you pay for those contracts, you got to be willing to lose it all because there is a chance that that whole amount you spent will be gone.
100%.
And sometimes it doesn't even take till expiration. Sometimes you look up and
you
10
turn
minutes
around the very
later,
next day. Or even 10 minutes later, yo.
And you're like, dang, I shouldn't have done that. Maybe if the timing was a little
I don't know how many messages I've received from folks in the sense, and I guess we'll get to it in a little bit later, but I don't know how many messages I've received from folks where that's just a heartbreaker. That's the heartbreaker story. So what do you do then, or what do you suggest to people to protect their risk? So first things first, to protect your risk, I mean, try the very best you can not to play short term, because a lot of folks try to play short term, and the thing is, it's like it's I don't think nobody's even perfect as it pertains to timing the market. The market doesn't go off of anybody else's time. It's led by billions of people that are trading at any point in time. And so, you know, when you play like these 2 week or 1 week long positions, I mean, you're putting yourself at the ultimate high risk. I like to say that most traders typically go by what we call a risk reward ratio of about 1 to 3 or 1 to 4. And so if you're playing, say, for example, those 2 week long positions or those short term trades, so anywhere from a week to a month, you're pretty much at high risk. The further out that you start to play positions, the less risk that you take on. Did you lose me, or am I still here?
And for those on the IG, okay. Mark is coming back. Yeah, you're back. You're back.
Yeah. For some reason, when my screen like Instagram keeps like dimming my screen, so it goes out.
It's been happening to me too. I've been having to like I had to move it closer so I could reach to keep it on.
They're hating. All right. So, you know, the best positions and the best strategy that I can always say is play the long term, anywhere from 6 months out all the way to, say, for example, 2 years out. And that's the furthest that an option contract can go, 2 years. Yeah. And when you play that far out, then you substantially decrease your risk. Now, of course, it also comes into consideration where you pick your strike price and all these other things, but still your risk is significantly lower in comparison to trying to play and trying to time the market and playing, say, for example, very short-term positions. So that's one of the significant ways that you can you can literally decrease your risk substantially.
And it's because of time value, right? So like, for those that don't know, so the options, like the premium that you pay for each contract, the big parts of it are like there's intrinsic value, which is the value between your strike price and the actual price of the stock. Price. Yep. So there's that. But then also 2 other things come into play. There's time value. So like that value between, and Mark, I'm sorry, I'm a teacher. So that's why I'm like, just in case people don't know.
Do your thing. I'm sitting back and be like, oh, that's what it feels like.
Like, yeah, you know all this stuff, but this is not for you. This is for them so that they like, we're not just like gibberish. We're like, wait, what is that? I don't get it, Teri.
We're here for y'all.
But okay, so you got that the intrinsic value, which is the difference between the strike and the stock. But then there's time value. So that difference between like how far you are from your expiration, from like current day to expiration, there's a piece of the premium that's inflated for that time value. However, the further out you go, the less that deteriorates. Like as you get closer and closer to expiration, that value is going to go away and you're going to start losing value in your premium. So like it's really cool and good for you to start getting expirations further out, because then you don't have to worry about that time value. You can solely focus on the stock price moving, right? 100%. And then a little piece of it too, just so you guys know, is volatility. And a little while ago, I did a video on why not to trade during earnings. And for professional traders, like they love trading during earnings. So I know, Mark, you're going to be like, you should trade. What are you talking? Why do you tell them that? But the thing is, during earnings season, those premiums are really inflated because of volatility too. Yep. So that means they're really expensive. It's kind of like the difference between buying Pringles at the airport versus buying Pringles at the grocery store. Like, you know, Pringles are only 99 cents, but when you get to the airport, they charge you $8. So anytime that there's a lot of volatility, those premiums are going to be really inflated and really expensive for no reason. Like right after earnings, they're going to lose value. So that's another thing. Yeah.
It's like the air is like there's so much air pumping in a balloon. And then when earnings happens, after like the first hour of trading in the market, you typically see that balloon just.
Yes. Yep.
And then everybody's like, well, what happened?
Right. And then they're like, wait, but I thought I was in the right direction. And you're like, you probably were, but just because of the timing of when you got that.
Yes.
See, so, okay, so this is where I pulled out my notes too. So y'all, I'm learning too on this call. So usually I tell my students that I want them to go like 2 months out if they're buying, like if they're buying puts or calls in an option, I want them to go like 2 months out. But if they're selling on the sell side, that they can do it closer, like 2 weeks out, because then that time value goes for them. But it was news to me when you started saying 2 years. So like, what made you start looking at 2-year options?
2 years. So what I started noticing is that everybody typically pays attention anywhere from 2 months to really 6 months, and then you see a lot of institutional money pay attention to really 6 months to really a year and a half. And I started noticing nobody was really paying attention to the 2-year contracts. Like, they weren't getting any love, none whatsoever. It was like, there was very little volume. There was very little open interest at the time. And so what I noticed is that I was actually able to get a better price, even though, of course, setting my strike prices and everything else within par based upon year-over-year percentage and all that other stuff. But I was able to get a better price than paying, say, for example, within the 6 month to a year-long strategy. So at that point, I said, oh, this is completely different. So I said, okay, let's run an A and B test. So I took a year-long contract, and then I also took a year-long 2-year contract. Man, when I tell you the differentiation as it pertains to the returns and what it brought, my 1-year position brought in about an 800% return, but whereas my 2-year position was producing for me about 2,400% return. And it was just completely different. So like, for example, you could be in the 2-year trade, and then within the first 3 months, you're already up 800%. So with that, and then keep in mind, you also have a ton of time, so you don't have to really worry about that theta, or what we like to call time decay. And so at that point in time, now it's really working in your favor. And so now what I do is, as my strategy is, I typically play anywhere from, I'll sometimes play a year-long position depending on what's available there. But then I mostly play the 2-year long positions. And then throughout the 2 years, I'm literally hedging against myself.
I was going to say, okay, so as you have this like 2-year option, are you selling like shorter term ones against it, or are you?
I'm definitely shorting against my own long-term positions. So I'll play a short-term put against my 2-year long position. And I probably do that maybe 3 times a year, or sometimes even, maybe just twice a year, depending on what the year looks like. But I mean, any capital or any profits that I'm losing to the downside, I'm gaining in that put as I'm betting against myself on the downside. So then I can use that to retool into my position to add more contracts, or to add leverage and find another position to pretty much, now I have 2-year contracts, or 2-year positions that are going out there.
That's wonderful. Do you mind?
And it's just safer.
Yeah.
Go ahead.
Like, do you mind if I take a second to kind of explain what you just said to everybody? They're like, wait, he does 2 years, and he sells against himself, and then what does he do? And then so
by all means.
Okay, guys. So what he just said in a different way is, okay, imagine this. So there's something called like a covered call. And I'm going to explain that, and then I'll explain like what he's doing with options. So a covered call is, say you have like 100 shares of, let's say, Netflix. You have 100 shares of Netflix for like, you got in at $300. And then a covered call is, in options, they will pay you to sell the stock. So a covered call would say, well, I got 100 shares at 300, but I'll sell it to you at $400 if you pay me some money, right? Yep. Like, that's that premium. You get to take in that premium every time you sell. And so if you're saying I'm going to sell it, you'd be like selling a call. So you'd have stock, and then you'd sell a call, and they call that a covered call, because every time, like if Netflix didn't get to 400, you would just take that premium and keep your stock. Yep. But if Netflix came up to 400, then you would sell the stock at 400, but you still get to keep the premium. So now you made the difference between where you got into the stock at $300 to $400. You get to still make that money, and you get to keep the premium from selling the option. Yep. And so what Mark is saying, and tell me if I'm wrong, Mark, But what Mark is saying is instead of buying the actual stock, he's buying like longer term, far out call. Like, I don't know if it's calls or puts. You said puts.
Yeah.
But
so my calls are the long term, and then my puts are the shorter term.
The shorter term. So he's basically, instead of like buying that stock, he'll actually do it in an options contract that's a 2-year option. And then how often do you do? Like every week or 2 weeks when you're selling against it?
No. So typically when I start noticing that the performance in the stock is starting to get a little long in the tooth, then pretty much I start putting out puts against it. And so when I notice that we peaked, play the 3-month put, and then let it fall to the downside, hit that first or second support level, and then out.
Bam. And then you can do it again because you still have the other position.
There it is.
Cool. So I feel like I'm an interpreter right now, but like you guys hopefully on the call are following too. I'm just helping for anybody who might not be following. So what he's saying is like he'll have that longer 2-year position in the option, and then he'll just sell against it on a shorter term basis with the market action. Because when you're 2 years out, you don't really you don't have to worry as much because you know that eventually the market's going to do what it's going to do.
100%.
But if there's some short term action, so for example, our president says something stupid, or the company like all of a sudden says something crazy at earnings, right? China comes and says, "Give us, all of our money for everything you took from." I don't know, but just there's random stuff that happens. He can actually trade that on a shorter term basis. And the cool thing though is you're doing it in puts. So I want to learn about this because I would be more of like I'd be like selling puts, I guess, or excuse me, I'd be like selling calls so I could bring in a premium. But like the cool thing about that is like, as I'm bringing in that premium, it's paying for the other position. Is that what you're doing too?
So sometimes I do that, but for the most part, no, I'm just playing the put. So that way I could just literally just say, okay, hey, I just want to take the profit and literally move it into something else. So I literally leave 20% on the sideline to literally use. So I'll leave 20% of my portfolio on the sideline just for puts, just so that way it's like I'm literally betting against myself. So for example, I think I just executed the sell on my puts, I think yesterday when the market had pretty much topped out. And then today I use that capital that I use puts against to literally re-up into my position because it brought down the price. Okay.
Told you I'm taking notes. I got my pen, got my notepad. So you're gonna see me like put up a trade and you'll be like, I taught Teri that. Yep.
It's all good. It's all good. Like I always tell people, the information is out there. The only differentiation is just that some folks just know how to analyze it better, and it's our duty to make sure that everybody can learn it.
Yes. Now tell me this: what kind of? I've heard that you like trading ETFs. So like, where did that come from, and like, what type of what helps you select what options you'll go for?
Okay, so I do also trade regular stock and options. But when you're trading stock, it's more expensive versus ETFs being cheaper. That's the first advantage. When a stock goes down, when you're trading in a singular position, you're taking all the risk of that singular position. Whereas, for example, if you're in an ETF and if one of the stocks is down, there's a package of other companies that are within there. So then that way my downward risk isn't so high. So now I just have something that's cheaper, and on top of that, my risk is also substantially lightened. So, and how I choose my ETFs is I choose it based upon the companies in which that I really, really like, the ones in which that I deem as winners. So, for example, if you like an Apple of the world or Microsoft or Amazon or Tesla of the world, you would look to find ETFs that have those within the packaging. And of course, make sure that the other packaging inside that ETF also looks good. Yeah. And boom, there's your ETF trade. Same rules apply.
Nice. So like if you're looking at those technology companies and maybe you're looking at like an XLK ETF, or if you're looking at like semiconductors, maybe you're looking at like an SOX. Okay, you look at SMH. I look at SOXL.
SMH is big.
Okay. And like
wait, my wife didn't hear that.
Or your dog, because I mean, like, I think you're giving affection to two, like, just playing.
No, SMH. I like the other ETF as well. They both pretty much operate at the same time. But the reason why I like SMH is because it gives you more so real time as it pertains to what institutional investors are doing. So, for example, you can see the restructuring of inside the ETF, as well as you get the market cap weighting.
And what about the expirations? Does it have weekly expirations, or how often does it expire?
It has weekly expirations, and they go all the way out to 2 years.
Nice. Because, yes, I think SOXL doesn't. It has like monthly expirations or something like that. So you can't, you can't trade it as often.
Yeah, I like those 2 year trades, especially within ETFs, because here's the cool part, especially the index ones. Because when you look at the index funds, they give you an idea, especially since it's a sector. It gives you really an understanding of where the market is. It really helps you look at and say, okay, hey, now I can kind of get an idea and trajectory of where the market's going and where is the money going into. All right, I'm sorry again.
It's okay. Here, while you're working on your Instagram video, and Instagram, just FYI, we do have the link in our bio. We have a webinar going on. So click the link in our bio. You can get the replay from the webinar, and you can
I'm
be
back.
on here if we go on longer. Cool.
I am back.
Nice. While you were working on it, I was gonna tell them like a couple ETFs that follow the market. So like some of, like, if you're following NASDAQ, and let me know if you do some different ones, because I definitely want to know. But if you're following NASDAQ, you could do like the QQQ. That's one.
QQQ.
Or that's the one you do. Okay. If you're following the Dow, you could do DIA, and these are spider ETFs. So if you wanted to look them up and see like what's in them, just do SPDR. They don't spell out spider all the way. I don't know. It got lazy. They were like, we need a ticker symbol for spider.
We had to be attractive to millennial investors.
Yep. They're like, oh, if we spelled it out, it wouldn't be cool. I don't know, but it's SPDR ETFs. Just Google that. So DIA is one, and then if you're doing SPY. The S&P, is SPY. Yes. Yeah. So those are some if you're trying to trade options with the index that you can check out.
And then you also have the sectors. I mean, you have the select sectors. They have the spider select sectors as well. And then if you like, for example, Tesla, there's ARK, which I'm a huge fan of Cathie Wood. I mean, she knows her stuff. And then on top of that,
she manages that ETF.
She's the chief investment officer for ARK Fund. So that's the ARKK, ARKW, if you want Amazon exposure. And then there's one of my favorite ones is FDN and SMH, of course. And that's First Dow Trust, internet companies, and then SMH Semiconductor.
Oh, that's good. I hope y'all were writing all this down. Did you get it in your notes? Because I surely got it in mine. The one that you said that I don't do is, you said is it FDT? What was that one? That was
F as in Frank, D as in dog, N as in Nancy.
FDN. Okay. That's the one that I don't usually have, but it's a
sleeper. It's a sleeper that a lot of folks don't pay attention to, but pretty much any of the millennial internet companies that are doing something, they're in there.
Okay. Now, so we talked a little bit about how to protect your risk. We talked a little bit about investing in ETFs with options. What other tips and tricks do you want to share?
I mean, we can talk about how you pick your strike price.
Yeah, that's good. Yep.
So I guess first, before I do that, I guess I can talk about like how is it that what sources and tools do I use?
That'd be good.
So I'm a huge fan of barchart.com. I'm a huge fan of that site because everything that you need, they literally, and it's data focused, so not opinion focused. So you can literally just look at the data. And it pretty much updates pretty well. But one of the things that I love about it is you can look at the performance. You can look at what is called the trader's cheat sheet. So it shows you the technical analysis, like, for example, RSIs. I mean, if you're a Fibonacci fan, you can look at that too, or stochastic. I mean, but, I typically like to look at the RSI.
Okay. You're like, if you do this, okay.
I mean, depending on how you like to play it. I mean, when you typically play long term, you don't really have to get so enamored into those things. But what you can do though is you can use bar chart to also help you find your strike price, and that's pretty cool. So if I'm looking at a 2-year trade, I can look at the 2-year performance of any stock or any ETF as well. And pretty much what I like to do is, here's my formula. So if you want to write it down, by all means, go for it. So, so pretty much what I do to make it happen is I look, if I'm playing a 2-year position, I look at the 2-year performance. It gives me, say, for example, a number. Then I take that number and then I divide that by 1.5%. So, or just by 1.5, 1.5. And the reason why I say 1.5 is because you're never really going to be in the 2-year position for 2 years. You always want to you always want to come out on top. So I typically leave about 6 months on there. So I'll say I divide that number by 1.5, and then I'll multiply that times 0.1 because I also calculate 10% corrections when I'm looking for a strike. Then you add that to the current price and boom, there's your strike price.
Nice. Okay. I'm going to have to make sure to watch the replay. Make sure that I've listened to that a couple times. Anybody
I'll
else?
give you an example.
Okay, good. And then I see, Craig, I see your question in here. We'll answer that right after this. Go ahead.
So say, for example, company X has a stock price of $100, and they've been growing pretty well. Now, over 2 years, let's say that they're up, they've gained about, let's say, $50. So that lets me know that out of every year, they're pretty much growing on average of about $25 per share. So what I'll do is I'll take that 50 and I'll divide that by 1.5. And then with that 1.5, I mean, for anybody that wants to play with your calculator, by all means, I'll take that 1.5. And then after I've divided that, I'll then multiply that times the 0.1 because corrections come almost every 16 months. And that's pretty much where the market falls 10% from its highs. So then I calculate that into my position. And then I add that to the $100 of the current share price. And then that's my strike price when I'm looking at my 2-year, when I'm looking to play my 2-year position. Now, typically that's me playing the strike prices conservatively with the expectation that I'm going to definitely exceed that and play better.
Now, tell me this, like one question I have with that is, so you're basically, and you're doing this with a call?
Yes.
Okay. So like if your strike price, that means your strike price is significantly out of the money. Mm-hmm. As the stock is moving, that means that premium's not moving a lot. Like, how does it move a lot? Because
it starts to move. So remember when I mentioned where some folks, they can be up by 800% within 4 months?
Mm-hmm. That's why. Okay. Because that's the piece where I was like, whenever I pick options that are further out, like longer expiration, I guess because the volume's not there, like they don't move very much.
It depends. It depends upon the position in which that you're also playing, because of course you also have to look at the interest. Is anybody looking to buy that amount of shares? But for the most part, when you play within the pond of the consistently used either ETFs or stocks, I mean, like for example, I was playing a put on a specific position. I guess we can't go into specific details.
Okay.
Or not.
You okay, tell me what you want. Hey, I'm here for it.
I played a short on Kodak.
Okay, yeah.
I played a short on Kodak.
Like after Trump said what he said? So like after they got that bid and right after it fell?
It was like right when it spiked. So at the peak, I said, okay, something don't smell right. And so how is it, so then I played a put against it. And pretty much from the highs, I had an October, I think 16 expiration date. I sold. Now, normally on any other put that I would play, I'd be up, a few 100% on this position. But given that it was Kodak, since there was no buyers really there, I sold, and my position was at a profitability of only 55% or 60%.
Okay.
Now, say for example, on my XLK put that I just recently played, that gave me a return of about 97 to, I think it was like 150%.
Mm-hmm. So what he's saying, guys, is because like anytime you're in the stock market, it's a negotiation between buyers and sellers.
Mm-hmm.
And because he did that put on Kodak, it went in his favor, but there was nobody that wanted to buy it from him. So he had to take a little bit of a loss to get out of the trade because nobody wanted to buy it at the price he wanted to get out of it. So
I sold it at a profitability of 55 to 60%, but I could have gotten way more if there were interested buyers, but you know.
Got it. Okay, yes. Because
Robinhood traders weren't messing with me.
No, they probably were still trying to like.
They were trying to digest all the information.
Yeah, they didn't get it. They didn't know what was going on. But so like this brings up a good point. So guys, one of the things that you should know is that in options, there's something called a bid-ask spread.
Yep.
And my students always laugh at me because it sounds like I'm saying big ass spread, right? But it's big ask spread with a K.
Yes.
But that means that there's a difference between what the buyers want to pay to purchase the stock or the option and what the sellers want to pay to sell it. 100%. And if you buy, so the bid, under the bid section in your, like I'm visually thinking about like what a option.
You're visualizing the option chain.
Yeah, the option chain. So like under the bid, that's what you're going to have to pay to buy the option. And then under the ask is what you're going to have to pay to sell it. And so like literally what it sounds like in this.
Wait, flip it around.
Just
did I flip it?
Yeah,
okay. You flipped it.
I was like, okay,
so
wait.
The ask is what you will buy at. The bid is what you will sell at.
Sorry. Yes. What the sellers are asking for.
Freudian slip.
Right. Sorry. What the sellers are asking for, that's what you're going to have to pay to buy it. And then what the buyers are bidding to sell it for, that's what you're going to have to pay to sell it. 100%. Sorry. Yes.
We good.
But the point is, oftentimes there's a spread there.
Yep.
And you got to know that going into options, because a lot of times, like if you buy something and there's a super big spread, just know that the stock has to move. It has to close that spread and then keep going for you to be profitable.
Yep.
And if there's nobody, like to what we just said about like on that Kodak trade, nobody wanting to like buy it back from him, the spread probably was just really big. So you can't get back what he actually, I want to say what you deserve, but you know, like what you could have gotten, because it's still a negotiation between buyers and sellers.
There's no friends on Wall Street.
Yes. And then there was something else that I wanted to mention. Okay, first let's answer. There was Craig's question, and there's a couple things that I do want to break down for us. Uh-oh. Now I'm stopping on Instagram. Come on, Instagram.
I told you that.
All right. Everybody, the 460 people on Instagram, make sure that you click the link in the bio so you can get over here to the webinar, because y'all know in a minute it's going to cut us off. We don't know if we'll be able to save it. Like, right. Craziness. So make sure you come over. We got about 835 people strong in the webinar. So Rocket, like shout out to you guys.
We're here. Thank you for joining.
Yes. Learning about options with this like melanin popping is just wonderful. Mark is like, who is this girl on this call with me?
You're good.
But here we go. So a couple questions. Craig asked, he was like, what is the difference between buying a put and selling a put? Because we were talking about buying and selling off earlier. And then someone also was asking, like, what is a put and what is a call? So guys, I will say, like, Mark, do you have a class yet? Are you? I know you have the Come Up series.
I just teach through the Come Up.
Okay, so
but you never know. Everybody's been asking me like, "Yo, when are you gonna get this class going?" I'm like,
Tell them my friend Teri has a course that teaches options. You can go take her class. So definitely check out the Come Up series on YouTube so you can hear more from Mark and you can start getting these terms in your head. And then if you want to like really start learning, like, okay, first you got to learn how to trade stocks. I think understanding how to trade a stock will be really helpful for you when you move over to options. So
that is a must. If you do not understand the fundamentals of stock, then please do not ever touch an option contract.
Yes. And I see a lot of people try to jump that step. they hear all these good things about options, and then they're like, oh, well, I want to learn options. And then they'll tell me, Teri, I don't need that basic part. I want to just learn options. But I'm like, actually, I'm a technical analysis trader. So I think it's good for you to know how to read a chart to see like where the stock is going, because then it'll be really helpful when you start learning where to put your strike price and like how the stock is going to move when you do options. So like, for those, I did see some people in there that are like, if you don't understand these terms, take a course. Like Trade and Travel is definitely there for you. There's a free webinar at itradeandtravel.com, or you can just go to the class at Invest with Teri. We usually start a new cohort the first of each month. So come on in. We'd love to have you. But to answer these questions, so quickly, what is a call? What is a put? I can start, and then I'll let you go.
By all means, go for it. Go for it.
So when I think about calls, I think about an asset that is gaining in value. So for an asset that's gaining in value, that's like houses. So a house, usually you buy it at a certain price, and then you're expecting it to go up in value. So if you're buying a call, you're going to be thinking about, okay, I want to purchase the stock at this price, and as it goes up in value, my options contract is going to gain value, right? On the put side, you're thinking about an asset that will decrease in value. So I think of it a lot like a car. As soon as you take a car off the lot, it loses value.
Unless it's a Tesla.
Man, no, I'm just playing. I think Elon be like, I have thoughts about Elon.
We'll have that. That's a whole nother episode.
Right? Yes. Is this a valid stock price? I don't know. No, I'm just playing. But so anyway, so think about a car, you drive it off the lot and it starts losing value automatically. That would be a put. You're assuming that this stock is going to go down in value, and you're actually going to make money as it goes down in value. Because here's the thing, you're going to ask somebody, like if you're buying a put, you're going to ask somebody like, will you let me sell it at this higher price? And then as the price goes down, you get to make money because you sold it up here and it's only worth this lower amount down here. So like that's the difference between calls and puts. Calls, you're thinking the asset will rise, and puts, you're thinking the asset will fall. And yeah, I was gonna say, anything to add there? Okay. and then Craig, to your question, you said, well, what's the difference between buying a put and selling a put? So if you're selling a put, which I actually really like to do, when you're selling a put, you're basically saying, I will buy this stock from you at this price. And so if you're selling it and the stock price goes up, you just get to keep all the premium until the price comes down to where you want to buy it. So you're basically getting paid to buy a stock, which is Ackermans
of the world.
Right. Which is kind of cool though.
100%.
Because like, I mean, where else do you get paid to do what you wanted to do anyway? Everybody else is just spending money to buy a stock, and I'm getting paid to buy a stock. Like that's a cool thing, right? But you have to think about it like that.
Indeed, 100%.
So,
I mean, here's that question.
So, how about this? Like, how about this? You want to answer some questions, and then if it brings up anything, we can kind of also give some extra tips.
For sure.
That sound good? And thank you guys for Instagram too. Y'all are staying on here. Like y'all know, it's 8:53 and we started at around like a little before 7. So it's going to cut us off of Instagram soon. So make sure that you click the links in our bio if you want to stay on here while we answer questions. But y'all put a happy face or some type of emoji in the chat or the comments if you all have been enjoying this conversation. Have y'all enjoyed this?
Yes, I mean, I know I have. So
me too. I'm having fun. Martinique's like, yes, please, a class. Someone said they love the Come Up series. There's a lot here.
Thank you.
Yes. Oh, now the I have not seen the chat running this fast.
I think it just like loads. I think there's like a loading time or something. Like there's like a delayed stock ticker. And then
All of a sudden, it's like as soon as Teri asks us, we are gonna just flood this. I love it, y'all. Thank you, thank you, thank you. And y'all press like and press share on this IG. I don't know like how long it'll stay up, but at least some more people will see it and know that we're out here. If anything, I just love like I love that like these are two Black investors doing extremely well. And like we're giving information out because we really do love y'all. We want y'all to be great traders. And it's just really cool.
I think for me, it's like what I said, and I think I mentioned this a while back, is like, you know, a lot of folks don't realize exactly when you reach the top of the mountain, it gets really, really lonely, especially when you don't see people around that look exactly like you. I mean, me being in venture capital, it is super duper lonely because you definitely don't see people around that look like you. And so for me, it's just like I wanted to just dedicate, you know, a part of my life outside of, you know, my family life to helping, you know, the culture itself realize, one, you can make it up this mountain, and two, there are people here to help you. And then three, when you make it up this mountain, you'll realize just exactly how different the air smells and tastes. And that's my focus. So.
Yep. I love it. And I'll even add one too. It gets lonely, but also gets boring. Like I realized recently I was kind of in a funk and I was like, Teri, you know, like, why are you in this funk? Like, I've been working so hard to get to this level. Like, yes, I've made the millionaire level and I paid off my debt. And like, I have a house now paid off. And, you know, like all these things that I had been
all
working
these great
so
feelings
hard for. Yeah.
But then it's like if the novelty factor wears off. The novelty factor wears off. And it's kind of like you find yourself in that headspace where it's just like, yo, dang, I just wish the people that I grew up with or the people that know me were also in this position. And it's like, you know, you kind of like, okay, well, what can I do?
Mm-hmm. And have you been having fun? Like,
as you God, yes. Like, I mean, though that my production team, like for real, they are like Mark, it's a whole different ball game. But at the same token, yes, I'm having so much fun because let my wife tell it, like the moment where we talk about investing or money or finance or just startups, I light up. It's like I could be exhausted and then all of a sudden, all right, let's go. So yeah, it's definitely given me new life. And it's like just to see that at one point in time we rung the bell and now it's just like, okay, now who's answering to the bell? And it's like we're changing things and you're seeing the change. So for me, that's more than anything that I can ever ask for. 100%.
That's true. I feel the same way. Like today I had a headache and like I had been running all around.
That headache disappear when you get that appraised report or something.
Right. Like right now I'm like, you know what? I feel good. Like the headache's gone. Like I'm smiling. I'm happy. I'll probably have like a ton of energy after this. Like it's just fun. And it's kind of cool too to like talk to someone who understands your language. You're like, oh wait, I do this, and this, and like, yep, got it. I'm with you right there.
I'm sitting here at this whole conversation like,
yep, that's awesome. Okay, guys, so we have time for a few questions. Ooh, look at Instagram. Instagram says 9 seconds left. So you guys, I'm gonna stop it now. So it will say, come on over. Share to IGTV. See this thing, Lord Jesus, please let this work. I'm gonna press like 3 buttons and press a next, no title, because I just want it to actually work right.
All right. AirPods are now gone.
Coming, I'll be right there. How to trade options, post. Let's see if it'll save. Y'all know that sometimes it doesn't want to save.
Instagram be hating.
Let me switch to the other earphones. Says posting. Let's see.
And it's going to take a minute because I think we were like here for an hour. So
that's true. That's true. It's like the thing. Can y'all see that? It's like almost there.
Almost there. You can make it.
Come on. All right, y'all, while we're doing this, y'all put all your questions here in the chat and then we'll try to answer them. Mark, how are you doing on time? You have time? Oh, geez, did it do it? Oh, no.
I think it's there.
Is it? Because I like touched something and then it went to like someone else's live.
No, you're there. It's safe.
Yes.
It's there.
Success. Okay.
Right. No, we're good.
Awesome. Okay, guys. So I'm gonna scroll through the chat and just see. All right. So I see one from Matt. He says, "After I have strike price, how do I find bid price to pay for contract so I'm not overpaying for it?" Okay. So I think what you're trying to say is like, how do you know that the premium is right?
Yeah. So, I mean, whenever you're looking at the options chain, a good thing that you can look at is to see the flow of the options chain and to see the disparity between, say, for example, strike prices. So as it moves up and down the strike price, I typically say a good rule of thumb is you'll typically see it between 50 cents to roughly almost $1 difference. But when you see those spike differences to about $2 and higher, I'd leave it alone.
Okay.
I'd leave it alone. Because normally, and keep in mind, you have to think about an options chain. They don't all move at the same time. So it's like the things that are, of course, the ones that are expiring that week, they get the most amount of action and activity. But then as you go further and further down the line, it takes time for those things in the chain to catch up, but they will catch up.
Okay, I'm glad you told me they will, because usually I'm looking at the other ones and I'm like, they're moving and this is not moving and I did something wrong.
And when they catch up, man, the beat drops.
Okay. Note to self, be patient.
Yes.
Okay. I'm going to watch, I'm telling you, I'm going to try this and I'm going to be like, Mark, oh my gosh.
I guarantee you'll just be like, oh, okay, I'm just going to go to sleep on this.
And this is going to make me so excited too, because they're longer, like farther out. So I don't have to worry as much. And it sounds like you leave them in there for a little while and then just trade against them. It's
just simple.
Oh man.
And it gives you time to also, study up on the companies in which that are inside the ETFs or just the companies themselves. And then it's like you're also able to start plotting out your next move.
Mm-hmm.
So, for example, if I'm in a 2-year position and then a year has passed and I'm still in the position getting ready to leave it, I mean, I'm looking at, okay, what's happening in so pretty much when September hits, I'm probably going to be looking at, okay, what's going on for June 2022 or say, for example, September 2022. What's next?
Mm-hmm.
So,
and I'm seeing these questions coming fast and strong. So one of the questions, hold on, now I missed it. I'm like, oh goodness, that was a good one too. Okay, so here, I think we can answer this one. So on brokerage companies, we can each kind of answer. I use one called TradeStation, and I like them because when we're trading stock, they give us 4 times the buying power. So we have like a pretty big like buying power that I like. And then they also have like fast order entry times and like really good charting. So that's kind of the one I use. Who do you use?
So I use 2. So I use E-Trade and I use Interactive Brokers. Interactive Brokers, that's just it's just a whole different animal. I mean, because you're seeing like you're kind of like getting the closest glimpse of what you're seeing that's actually on the ticker. And then on top of that, I like using E-Trade because when it comes to this options chain, I mean, I think it's second to none.
Nice. Okay. I haven't used E-Trade for options.
So I've seen folks that have used like TD Ameritrade, Charles Schwab, and many other trading platforms. And when we're sitting back and going through, they're typically paying a higher price versus what I'm paying. And ultimately, I'm seeing mine like reflect pretty fast. And by the time when it gets to them, they're like, hey, I didn't see that.
I've heard that with TradeStation too, like on the good side, like they update faster than some of the other brokers. But good to know.
Yeah.
Good to know.
I also like the fact that if I deposit capital into E-Trade, I can immediately start to use it. Purposes. Sometimes brokers just make you pause for 3 days.
Yep.
That's like the worst feeling ever.
It really is. And to everybody who's on here, like one comment about that too is whenever you're opening your brokerage account, you may want to ask for margin on the front end. Even if you're not going to use it, that lets you trade faster. Like if you were to like have, not so much with options, but if you had like stock and you sold a stock and then it takes you 2 to 3 business days before you make your money back. Yeah. Like just also consider opening a margin account so you can trade faster. Not for you, but for everybody else. Oh, I love this. Oh, I just got a date request. Oh, I'm so excited.
Hey.
Raphael says, I'm also in Dallas. Can I take you to lunch? I'll wear my mask. Okay, now. You know what? See, Mark, I told you I had to go put my makeup on.
I'm just here so I won't get fined.
Okay, now, Richard, what's an options chain? You want to go for that, or want me to talk about that?
Sure. I mean, an options chain is just pretty much like where you get to see the list of prices on both the on both the call side as well as the put side. And it shows you exactly, it pretty much shows you what the buyer's interest is, also how much buying has taken place. And in some options chains, it will show you, for example, within the asking or within the bids, what was most recently executed at that price. But it pretty much is a place where it's like, just imagine it like a market where you can literally see pretty much the options that are available to you as well as the expiration periods.
Okay. Yeah, I would say the same.
It's like a fleet market, really.
Yep. Well, and it looks like when you're looking at it, it's going to look like at the airport where they have like all the flights listed out and the dates and time. Yeah.
It's like departures and arrivals.
Yep, exactly. That's what it looks like. And so that's why it's called a chain. That's what it looks like. So we have here, Jay says, can you explain the VIX volatility? And then I see a next question too. Oh, shoot, but it went by so fast.
So I'll quickly explain the VIX. So the VIX is pretty much a reader of the market. Some folks like to say it reads stocks, but also at the same token, it reads the options market. So for example, a lot of those folks that are playing out of the money calls or puts, when the market goes sideways and runs up against those, then volatility is created. The VIX is also a contract as well. So like, for example, for those, you'll probably, I don't want to give away anything that she's going to teach in her course, because she probably also teaches about quadruple witching and stuff like that.
No, go ahead, please. I don't teach about that.
I mean, the VIX is also a contract, just like the futures are a contract, options are a contract, and I think there's another one. It's just sliding my brain. But pretty much when you see the VIX, it's a reader of predictability versus unpredictability in the market. When the VIX is high, then that lets you know that the market is unpredictable right now. When the VIX is low, then that means that the market is it's not very predictable, but a little bit more predictable as it pertains to the trajectory of where the market is going. A good way to look at that is it's really an inverse of pretty much most stocks that you'll see in the S&P 500 or the NASDAQ or say, for example, the Dow 30. So a good read is if you like Apple, look at Apple and then look at the VIX. You may have to pull up two different charts and look at them side by side, but if you notice, when the VIX is spiked, Apple is down.
Mm-hmm. I actually did not know. Well, I knew that, but that's a good reminder that there's like an inverse relationship between the VIX and Apple stock.
Mm-hmm. Oh, somebody asked about Bollinger Bands. Oh, I got to sip water on that one.
Now I'll tell you the truth. Like my strategy is pretty simple. Like we're not using indicators. However, we're using formations and candlesticks. And then we're looking at like where those candlesticks are saying that the banks are buying and where they're showing that the banks are selling. I know
when you see it long, then that lets you know that there's a lot of buying, or if it's green, and then if it's long in the red, then of course it's showing you that a lot of institutional money is selling.
Mm-hmm. Well, it's a little bit more into sense than that. So not that basic.
Oh, okay. I know.
but yes.
So
go ahead. You can talk about
Bollinger Bands. So should I explain that one? So Bollinger Bands is like, think about it like, man, I wish I had my rubber band here. So think of the Bollinger Bands like a rubber band. And so if you're looking at any stock, you can kind of get an idea of what the volatility is within the stock and looking at a Bollinger Band. When it's expanded, then the volatility is high. When it's contracted, then that lets you know that the volatility is low. That's the first thing. The second thing that you can look at is it also shows you a high, median, and low. That's pretty good because when it's at the high, above the high line, it's kind of telling you that, okay, hey, it's gotten a little bit long in the tooth. And typically when you see the stock come outside of the band, it will naturally retreat back inside the band. It's a very good indicator for you to be able to say whether it's on the high or low side, the stock will always come back inside the band, if not come back to the midline or trade along the midline or trade somewhere in between. But it always retreats back inside the band. So that's the cool part.
Nice. Nice. So that's a good little added indicator or thing that you can add to your charts to kind of help you decide if you're taking the right trade or not. Okay, guys, I'm trying to get through these comments. We'll take a few more. There's so many. It sounds like you guys want us to come back and do this again. Is that a yes?
Yeah. Can we do it again?
Because we have so many questions here.
People are writing it all. Like some people are like copy and pasting the same question, just like flooding it in all caps.
Goodness. Did we answer your question to those people that did that? Okay, and then so Annette has asked several times too. What do you think about the XLY?
Oh, I love it. I mean, I think that in my opinion, hypothetically, I believe that XLY will probably be one of the best sectors on the market going towards the end of the year. So
take down.
Yeah,
I hope you guys are
I strongly believe that. I mean, XLK will continue to do its thing, but I like XLY going into the second half of the year.
Nice. And we're getting a lot of yeses to us doing a second event. People are like, yes, ma'am. Yes, yes. So if you're open to it, Mark, maybe we could do another one.
For sure.
I'm even looking at this. I'm like, you know what? We could do this on YouTube. We probably have gotten a lot of super chats from this. Okay, Mark, you have to invite me to your YouTube.
I'll bring you on. I'll bring you on to the Come Up series. We got to do it.
Yeah, I'll do it. Let's do it. I'll be there. Okay, guys. Mary's like, yes, got her on camera saying that she'll do it. Okay, guys.
What they want.
It's true. I'm here for it. Whatever you need, I got you. Well, right. This is just fun though. I love it. Anytime. All right, guys. So y'all have so many questions. I think what I'm going to do is answer and then they're going so fast.
It's coming in super fast.
How about this, Mark? You pick one question randomly. I'll pick one question, and then we'll wrap up.
I'll help you. You want to pick the first one? If somebody says answer Nadim's question. Okay, Mark, can you talk about the equation for 6 months or 1 year strikes? Okay, so the same rules apply to, say, for example, anywhere from 2 years and bringing it on down. So what I mean by when I chose the 1.5, if I'm in a 2 year trade, I'm getting out at the very latest in 1.5, so a year and a half, year and 6 months. So that's the reason why I apply that to my equation. Some people try to divide it by 2, but I mean that means that you're at the expiration. That doesn't make any sense. All right, so what I do is if you're in an option trade for, say, for example, 3 months, you're really playing it for 1.5. If you're in, say, for example, 6 months, you're in there for 3 months. If you're in a 1 year, you're in that for 6 months, and so on and so on and so on and so on. So when you apply that equation, you look at, say, for example, its performance report, and then you take into consideration, say, for example, it's the time that you're willing to be in the position. Then on top of that, depending on the timeline, if you just happen to be playing short, you look at, instead of a 10% pullback, but if you really want to be conservative, please do that. Or at the very, very least, play, say, for example, 5% pullback in the market. So you apply that to your equation and then add that number to, say, for example, your strike price or to your current price, and then there's your strike.
Excellent. And then, okay, you guys, a lot of your questions are around exiting and charting. And so I would say for all of you guys, make sure y'all do check out the course with investwithteri.com and check out the Come Up series on YouTube as well. Because I think some of these things you'll learn over time, like us explaining it in one moment won't be enough. But I will say, Damon says, explain the covered call a little bit more. I do want to explain this a little bit just because right now the stock market's getting back towards all-time highs, and like we could see a pullback. So for a lot of you guys, like honestly, if it was me, I would be looking to like sell some of my positions that I made a lot of money on, because you can always get back into the position. You don't have to, you know, like you don't have to ride it. Like you kind of riding dirty, like real dangerous right now when we get back to all-time highs. Like there's more room for the market to fall than to go up, right? Mm-hmm. But if you're in like a long-term retirement account or a long-term account and you're like, I'm going to be a long-term investor, I never want to sell this stock that I have, one option is that you can sell options against that stock. Mm-hmm. And what that says is if the stock comes up to this price, then I can sell it and just keep the premium. But if the stock doesn't come up to this price, I'll just take in premium until the stock comes up, and or until that option expires, and then I just keep the premium and the stock. Why that's important for you right now is because if the market does fall while you have those stocks that are in retirement, at least you make money on them.
You're protected.
You're a little protected. So that's what a covered call is. And you would need to have
a hedge.
Yeah. And you would need to have like 100 shares to be able to sell a contract against it if you were doing it as a covered call. You could also do that in option world and you wouldn't have to own the stock ahead of time.
Right.
But that's what, So, all right, Mark, how can they find you?
You can find me on Instagram at I am Mark Monroe, Mark with a K, by the way, no C. You can also find me at That Come Up series on Instagram. I mean, we tag team there with my team, or you can just watch the Come Up series on YouTube. Search for us as the Come Up series, and there will pop up.
Nice. I love it. Thank you so much. And for me, you guys can find me on Instagram at I'm an Investor, but also on all channels at Trade and Travel. So on YouTube at Trade and Travel, we're starting a Instagram thing at Trade and Travel. And if you want to learn like a free webinar about how I make $1,000 a day, go to itradeandtravel.com.
Nice.
So start there with the free webinar and then come join us in class. All righty.
There it is.
All right, guys. Well, thank you guys so much for joining us. I hope y'all had a good time. And thank you, Mark. This was excellent. It was really fun.
Thank you for having me.
Of course. Bye, y'all.
Bye.